All right, let's finish up talking about dividends here. And in this case, we want to talk more about the actual process, the theory ideas. What does policy, or what is the relevance of this? Why is it so important? And one of the things that we'll find, and it says here that there are a lot of things that are probably a little bit more important than the payout decisions. The actual findings in the research that's done really is kind of mixed, if you will. Some literature, some research tells us that dividend policy is very important. Others say it's not. But in general, I mean, dividends are a form of financing because they impact retained earnings. So really, the payout policy should be considered to be part of the capital structure decision. So companies, again at the end here it says, companies shouldn't sacrifice good investment in financing decisions for a payout policy that is in the end of questionable importance. So the question we want to ask is, how important is it? The first school of thought that we can think of is that follows the concept that investors, the shareholders of a company, are considered to be residual owners. So if you take that to the extent and apply it to dividends, they should only get dividends if there is money left to return to them. So if there's something left over, they get a dividend. If not, they don't. So using this concept, we need to figure out what is the optimal level of capital expenditures that the company should buy. What is the value of all of their positive net present value projects? Once we know what their optimal level of capital expenditure should be, we then need to turn to the capital structure. We know what the proportions are. We know the formulas, if you remember. And again, because the cost of retained earnings is less than the cost of new common stock, we want to make sure that we apply retained earnings first, and then in the end decide whether or not we're going to have to issue new common stock. If there's retained earnings that are available after we have invested in these projects, then we will distribute that as dividends. But if there's nothing left over, then we ultimately have to go outside the company to get money. Dividends in that case would be zero. So the dividends in this relevance policy can range from paying out a dividend that will change from quarter to quarter to paying zero dividends. So it's going to be a very unsteady form of dividend. Of course, shareholders would like to have dividends that are fairly steady and constant. So let's go back to the idea of relevance, right? Are dividends important? If we change the payout policy, will that change the price of stock? And we want to go back to our Miller and Modigliani theory. They talked about this with respect to capital structure. And again, they've done some research and they say, look, in a perfect world, the value of the company is unaffected by the distribution of dividends. In other words, it doesn't matter whether the company pays a dividend, doesn't pay a dividend, increases or decreases. That's not going to have an impact on the value of the stock. Now, of course, we don't live in a perfect market, right? So there are some holes in this theory, but there's also some side hypotheses that really make some sense. So let's think, if we talk about them for a second. The first thing is the idea of the concept of something called the clientele effect. And essentially what this says is that investors don't just care only about the amount of the return they get. They also care about the form of the return. So some investors will prefer to get the returns in cash form, and others would prefer to get that in capital gains form. Now the tax isn't different anymore, but capital gains are still deferred until the sale of the stock ultimately occurs. So again, tax-exempt investors may want to invest more in companies that pay dividends because they won't be affected by the tax rate that goes along with dividends. Investors who'd have to pay higher taxes, though, would prefer to invest in companies that retain more rather than paying out their dividends. So if a change in this policy occurs, the value of the company won't change, because what will happen is those people who want to sell their stock will sell it to people that want to buy the stock. So in the end, the clientele effect says when a company changes its dividend policy, all it does is change owners. It doesn't have an impact on value. The next idea that goes along with this, and we'll talk about this obviously in more detail in the class, is whether or not what they refer to as the dividend relevance theory. That is, maybe it is important. Maybe there is a relationship we need to understand. And the idea that they use here is something called the bird in hand argument. And the bird in hand argument essentially says that dividends, since companies rarely change them, they rarely as we saw, many more companies try to maintain their dividend level than increase or decrease it. There's some certainty with that. So if companies are paying out dividends, or maybe a lot of dividends, investors are fairly certain that's going to continue, even the amount that they receive. So if you were to switch and then not pay dividends, you would be making the return more risky. And of course, higher risk is going to have an impact on required returns. So higher risk is going to increase the required returns, which means moving to no dividends would be lower the value. So the bird in hand theory says the company should maximize the amount of dividends that they pay. So again, we have one theory says it doesn't matter. Another one says maybe there's some importance there. Maybe there's a relationship. What about large changes in dividends? Right? We have seen that there is some observational information, at least, that when companies make large changes in dividends, there is an impact on stock price. And what they're referring to here is the informational content that comes along with this price. When managers change dividends, they're sending the owners of the company a message. They're giving them some information. Agency cost theory says that a firm that commits to paying dividends is reassuring shareholders that managers won't waste their money. They're putting them at ease. And again, although other arguments, may have been put forward about dividend relevance, empirical studies haven't proved that there is any conclusive settlement on whether or not dividends impact or don't impact the firm value. But we do realize that shareholders get information from the actions of owners. So this action could ultimately drive what happens to shareholder value. What kinds of things are involved with the dividend policy? In other words, what things do we have to consider? Number one, are there any legal constraints? Is there anything that we have to worry about from a governmental or a corporate legal standpoint that would constrain how much dividend we can pay out? In general, what that rule is that you have to have retained earnings. If you don't have retained earnings, you can't pay a dividend. Are there any contractual constraints? Maybe we have some restrictive covenants in our bond contracts with our creditors that limits how much dividends or what percentage of earnings we can ultimately pay out. What about the growth prospects of owners? right? If owners are, if we think that we have lots of growth potential, we would want to keep or maintain the money so that we can ultimately use that rather than external funds to buy things. There could be some owner considerations. Finally, what does the marketplace think about this? So let's talk about these briefly as we kind of go through the process here. The legal constraints, we've already talked about this, that obviously you can't pay a dividend if you are paying any form of the company's legal capital. That is, from the equity section, you can only reduce retained earnings. You can't reduce the common stock value. This is referred to as the capital impairment restriction. Sometimes, as I mentioned, right, there are constraints that have been placed in our contracts to protect us. Creditors don't want us to pay out all the money to shareholders. They want us to make the interest payments. So again, this is just another example of what happens with respect to some external environmental kinds of contracts and agreements that we have that might limit how much dividends we can pay. Growth companies are more likely to want to maintain the money and invest internally with retained earnings. A more established firm might pay out more of its earnings, particularly if it has ready sources of financing. But actually, as companies age, unless they're able to revitalize their brand, etc., in the end, investment opportunities dwindle. So they'll be able to pay out more money as their growth opportunities shrink. What about owner considerations? We have to worry about the tax status of our owners. If you have a lot of wealthy shareholders, right, we may want to reduce dividends so that they can defer their taxes rather than pay out the dividend tax when they earn it. Do the owners have investment opportunities that they need cash to make payments on that? What about the dilution of ownership? If you pay out a high percentage of earnings, new equity capital might ultimately need to be gathered in order to buy projects. That new stock issue might dilute both control and earnings for the current and the existing owners. The market itself, right? I mean, the market says that, the companies tend to want to cater to the preferences of their investors. So if they make some changes and this is appealing to investors, whether it's increasing or decreasing, then that could have a positive impact on the stock price of the company. So, what are the usual types of policies that we see? A firm's dividend payout ratio is the percentage of earnings per share that are paid out in the form of dividends. So the retention ratio is the percentage that's been kept. So companies can have a constant dividend payout ratio. That is, they keep whatever the earnings are, they pay out that percentage to owners each dividend period. The challenge with this constant payout ratio is that as earnings throughout the year vary, the dividend payment is going to vary. And of course, we know that shareholders really don't like dividends that change very much. How about a regular dividend? They're going to determine what the dividend should be, some fixed dollar amount, and they're just going to maintain that fixed amount. In addition, we could have some kind of a target dividend payout. Basically gives us some range that we could use, and then we're going to try to keep the dividend payout in that range. But of course, we ultimately want to try not to decrease the dividend if earnings were to drop substantially in any one quarter. We could pay a low, regular, and then an extra dividend. Again, this requires some information. We have to have data we have to provide information to our investors as to why they're getting this extra dividend, so that when they get the next dividend, they're not expecting that extra amount. Again, it could just be this was a really good quarter, or maybe they do it once a year. They evaluate how the year went, and at the end of the year, if there's a little bit extra over, they send some extra money. But again, it's always in the announcement that you're going to get the low regular dividend we always pay, and then we're going to pay a little extra as this bonus. The last thing we really want to talk about is really the idea of what are referred to as stock dividends and stock splits. A stock dividend is the payment of a dividend, but it's in the form of a stock. Essentially, investors receive some additional shares, but everybody gets the same percentage. There's no cash, there's no real value transfer since everybody gets the same, but the number of outstanding shares increases. The stock price is going to decline roughly by the amount of the stock dividend. So essentially, all we're doing is rearranging the equity section for the company. Now, a stock split is a bigger, if you will, stock dividend. The difference between the two and how it impacts the company has nothing to do with value, but has everything to do with accounting. So a stock dividend and a stock split are journalized differently, but they have the same impact. Again, in this case, it's not unusual for a stock split to cause a slight increase in the market value of the stock. This is because we're giving some information. It has nothing to do with the split itself. It has to do with the information that we're providing to the public. Stock splits will typically reduce the dividend or reduce the stock price, and in the end, a reverse stock split could ultimately make the value of the stock move in the opposite direction. So here we have this company. Here's their before split. They have 200,000 shares at $2. They have some excess paid in capital. They have some retained earnings, and they have a total equity of $6.4 million. So now they're going to do a 2-for-1 split. So what they essentially do now is that they have 400,000 shares, twice the number of shares, half the par value. So the only thing that changed here was the common stock number of shares, not the value, just the number of shares. So in this case, you can see that that the stock price didn't change, that the company was able to maintain or keep the same value. What this does is ultimately reduces the market price so that maybe more people can buy the stock. That's the end of chapter 14, and that's our discussion on dividends.